is that if you want your dollar back, he won't give you the dollar, but he will get you a Big Mac. So I mean, I think his system is great, and I just want to start with this disclaimer that this is that this webinar is for educational and demonstration purposes only, and Rightline takes no responsibility for any participation by visitors or subscribers for any profits or losses that may be incurred, that we're not, you know, certified agents to manage your money, and that you should consult with a broker before risking any part of your account. So, that said, just a little bit about myself, and I'm going to show you an indicator that you've never seen before, and that I think that you're going to find to be almost, you're going to find that you're not going to want to trade without it. At least we don't. And just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson, and I've been involved in the financial markets for over 20 years, and I've been trading the futures and forex markets for a long time. And I've been trading stocks also for almost 20 years. And really, Rightline is really based on the optimization of software systems. In my graduate work, I did work in mathematical modeling, and back then it was underwater decompression schedules. But the whole thing is really based on the same mathematical format, where we define independent variables that are responsible for the movement of price on any given financial instrument, and then we look to optimize these individual independent variables in an equation. And I just want to go over really briefly, because I don't want to spend too much time on this, that there is a problem with current technical analysis, and the problem is that 95% of day traders fail. And you know, all of you out there, we really have a nice crowd out there today. All of you out there know the difficulty of day trading, or swing trading, really the same thing. If you use the basic principles that you've probably been taught, they're going to cause you lots of problems. Because remember that 95% of all day traders fail, and what you've been taught is really the same technical analysis and the same indicator analysis that's been taught to the previous bunch of traders that all just went bankrupt. And there's no evolutionary process that takes place in this particular field. For some reason, people don't look upon this as a science. They look more upon it as an art. And if you look at any specific individual endeavor, whether it be architecture or medicine, let's say, you know, it was 300 years ago or whatever, and all the architects who erected buildings, 95% of those buildings collapsed. Well, what would happen is there would be a rigorous scientific analysis of all the principles they used to create the building, and those principles that didn't work would be eliminated. Those principles that did work would be magnified, and additional principles would be used to augment the ones that have been proven to work to increase the success rate. But for some reason, that does not take place in day trading or swing trading. We trade the same thing. There's no scientific look or scientific analysis that takes place to try to find out, why do so many day traders fail? What is the problem? What is the basic concepts that we are learning that cause us to go off the cliff? So basically, each generation of day trader fails to learn from the previous generation in the sense that they use the same stuff, they use all of the same indicators, and they're just destined to go bankrupt as well. I mean, they just don't have, there is just no way for them. So they accept current dogma without any mathematical verification. Now, I just want to tell you before I show you the trades and show you the indicator, is that especially when it comes to trading stocks, for some reason, they're the most, you're taught the most gimmicks. And what you're taught is to trade gaps based on some formula, whether to fade the gap or whether to trade into the gap, how to trade a market open, how to take a momentum breakout. But there's really no specific ability to ascertain whether or not these trades are going to fail or they're going to be successful. And really, a lot of the stuff that you're taught is really very, very gimmicky. It doesn't have any fundamental math behind it or any acceptable analysis to show you what the failure rate is and the success rate. And I'm going to show you a great analysis that's going to allow you to trade all these formations and all these setups with really a high degree of precision. And what we've done is we've created an indicator, and we call it our cash metrics indicator. And I'm going to tell you exactly what it is. It's not a black box system where you got to look at green lines or red lines and just go in the direction. I want you to understand what you're doing and completely and thoroughly understand what you're trading and why you're trading it. Now, here there are 21 metrics that go into creating these two lines. Now, I couldn't get them all. This is NinjaTrader, and this is the Instrument Manager. And these are all, now these are not futures contracts. These are not stock tickers. These never change. They never roll over. These are called indices. Some of them look and analyze specific ETFs. Some of them look at tick data. Some of them look at volume data. And they look at this data on different indices, different markets, different ETFs. They're all formatted out of Kinetic. And to trade this system, you're going to need a basic Kinetic data feed that's going to cost you $55 a month, so we can format these. And there's a couple more that are outside the window, but you're going to see them all. And you can put them into Kinetic, and you can see exactly what we're looking at. And we're looking at volume data, and we're looking at tick data on a whole bunch of various markets and ETFs. So what it boils down to is there are 21 indices that we've grouped into 4. We've grouped them into the Dow, the NASDAQ, S&P 500, and the Russell 2000 index. So these are all indices that hone down on what's going on in the Dow. These hone down on what's going on in the NASDAQ, S&P, and the Russell. Now, here are some of the things that they look at. Because again, I want you to understand what you're doing. One of them looks at the ratio of up-down volume. Another looks at the ratio of advancing issues over declining issues. Another looks at the ratio of upticking to downticking stocks in an ETF or in the market as a whole or a specific basket. Others look at the ratio of the advance decline line, again on specific ETFs, the ratio of upticking and downticking stocks, again in specific ETFs. They've been basketed so that they can help you predict the direction of the market and the direction of the stock or future that you're trading. And there are 21 of these. Now, these are the 2 lines. Now, there are 4 quant cash markets, 4 for the futures market, and 4 for the cash market. But they're broken down into E-mini, Dow, NASDAQ, and Russell. The upper line is all tick data. And the tick data tends to be faster. It has less specificity and more sensitivity. So it's going to come in quicker, and it's going to leave quicker. And the line, you can see, it tends to shift in color a lot faster. The bottom line is all the volume data. And it tends to come in a little bit later, but then it tends to persist throughout the move. So with a little bit of screen time and a little bit of work, you can put these two together. Now, by breaking it up into the fast and the slow line, it really creates a big advantage. If you see that first line come in and the move's evolving in your direction, that slow line is going to come in as well. And I'm going to show you lots of trade configurations and show you how it operates. Now, I want you to see, what I did was I took a whole bunch of different stocks on all different time frames and a whole bunch of different different futures markets. Now, obviously, on the futures markets, it's only operational on four futures markets: the NASDAQ, the Dow, the E-mini, and the Russell. Now, have you ever thought to yourself, if you're trading the NASDAQ futures market or you're trading the E-mini futures market, is there a correlation between the direction of the futures market and the direction of the cash S&P 500? Is there a correlation between the direction of the NASDAQ futures and the cash NASDAQ? And the answer to that is absolutely yes. And the correlation is fairly tight. So this is the first time when you're trading a futures market, you're going to bring in data from a cash market and use it to help you to determine the directional bias that you take when you trade the futures market. And you're going to find that it's really indispensable, because if you trade in the opposite direction, you're almost guaranteed to get stopped out. And if you trade with this particular indicator, the probability of getting a successful trade is markedly enhanced. I wanted to show you a 5-minute trade of Garmin. Now, I know Garmin it doesn't really matter, but it makes GPS equipment. It also makes a smart watch. And on a 5-minute, you can see that both of these cash metrics. Now, the one thing that you have to decide is which of these you're going to bring in. Is Garmin most affected by the NASDAQ? Is it most affected by the E-mini S&P 500, the Dow, or the Russell? Now, obviously, it's not affected by the Russell. I don't think it's a small cap. It's not affected, or a mid cap, but you have to check. What I did was I put the line in from the S&P 500. There's nothing to stop you from putting in two, but it's easy to Google the stock and determine what market it trades on, so that's really not an issue. And you can see when both cash lines, all the tick data and all the volume data are angled to the upside, you're simply looking for a long entry and a long trade on a 5-minute chart. Now, there's no particular entry, because I'm not giving you entries, and I don't want to mislead you as to what the indicator does and what it does not do. It is not going to give you an entry. It's going to give you an absolute directional bias. And that's extremely important, whether or not to fade the trend or to stay with the trend is going to be affected tremendously by these two lines. Now, here's a 60-minute of Akamai, and you can see that you've got a tremendous short trade when you get a short entry. And the short entry is best taken after a long pullback. That fails, and on a 60-minute, of a stock, I think, I can't remember what Akamai trades at. I unfortunately cut off but this is a $1.05 move on a fairly inexpensive stock. I just cannot remember what it trades for. In the direction of these cash metrics that are telling you what's going on in the individual ETFs that Akamai is in the overall NASDAQ, looking at volume and tick data. So you're not even going to think of trading this long. You're simply looking for a short entry and a continuation to the downside. And this is NVIDIA on an 8 range, and this was a real dive. You normally don't get the cash metrics just lock red like this. Now these are all recent trades. This was September 14th. Now this is on an 8 range. The last one was on an hour. I think it was on an hour. This is a 60-minute. Here's your 8 range chart. You made $1.08 and your risk is 10 cents. Remember, on an 8 range, your risk is 1 candle, 1 tick above and 1 tick below. So you're risking 10 cents, and on this trade, you captured the whole move to the downside if you did, and you're not going to pick the bottom, but you can pick close to the bottom. You can make about $1 on 10 cents of risk. Now, obviously here, you can't counter trend trade. What you do, if you're not in the trade, when the market moves up, you're going to take the roll to the downside. You're going to leverage every move up to move back to the downside. Gives you an absolute direction to trade. Here's Best Buy. Now I want to show you how to trade a gap professionally and the way the professionals do. They don't evaluate the gap, they don't use gimmicks, and they don't use nonsense. And they don't spend $5,000 to learn about a course that doesn't look at anything. If you notice here, the market opens, it's 9:12, here's 9:30. And Best Buy gaps up on a 5-minute. Now, what do you do with the gap? Is the gap going to run to the upside, or is the gap going to fade and close the gap? Now, as far as I know, there's absolutely no rule that you can follow or any way to rate this trade except by looking at market internals. That's going to give you the best potential for a successful continuation trade on this gap up. Now, if they're locked green, now obviously each individual stock within these metrics has its own relative strength. Now, Best Buy has real strong relative strength, obviously from the gap up. Now, the question is it going to be maintained? And with these cash metrics, that doesn't look directly at Best Buy, but looks at a basket of stocks it trades in, along with all the internals. In this particular case, I used the NASDAQ, which may have been incorrect, but I don't think it's going to be a whole lot different on the E-mini. You're going to get a nice long trade. You're going to get $1 on this trade, maximum. And Best Buy is not that expensive a stock. The risk to reward here is incredibly large. This is how you trade a gap. Now, I want to show you when you cannot trade. If you look at the close of the market on 9/13, the metrics don't align. The market's going up, the metrics are red and alternating in color. The best time is to stay away from this move. Now, the next day, this is Opco Kinetics. It's a small biotech. It's very cheaply priced, and I trade it all the time. It's what, and in my options portfolio, I use it a lot. Now here you get a gap to the downside, but initially, all the market internals and the ETFs are telling you not to take this trade short. Then you get a roll, and you go with the gap for the continuation short trade. That's how you trade a gap professionally. You trade it this way, and you wait for the break of the 50 in the direction of the metrics. They're going to always guide you in the appropriate direction. Now, here's another gap. This is on Syntax. I'm sorry, this is Console Energy. Now, this is really simply a market open trade. And you don't get many of these, but when you do, you roll with it. Now, the market open is always a period of relative of imbalance, because there's a lot of amateur traders that place their trades pre-market, waiting to get executed at the open. Now, there's certain tickers that'll tell you if there's a major buy-sell imbalance in a particular stock. Benzinga Pro does, sometimes Options Monster does. They'll flash a signal that tells you, there's 100,000 extra shares that are sitting pre-market, waiting to sell or buy a particular financial instrument. For the most part, we don't know what's going on. But when the market opens 2 or 3 minutes into the open, if both of these metrics roll green, and you've got the 50 green and the 15 green, you take your trade long, and you trade the open on a 60-minute Console Energy, and this is a $1 move on a $15.90 stock. It's a tremendous risk to reward on the stock, and you're almost never, just as Lee said, I'm going to paraphrase him, you're going to get losers, but your losers are going to be few and far between if volume is upticking on multiple different metrics, if stocks are upticking on multiple different metrics, and you're trading in the direction of the trend. You're going to very likely be able to pull out a lot of nice money from the trade at the open. Now, here's a more complex trade on Facebook. And this is a 60-minute on Facebook. And this is a very big winner. The market opens right here. And you can see that Facebook actually gaps down into the market open. Now, what do you do with Facebook? Do you take it short, or is there going to be a rebound as the professional traders move in to really determine the direction of the trade? And I think this is something that few of you are ever told. What creates a gap? It is not the professional traders, it's the amateur traders. Professional traders do not move in and take trades pre-market. Number one, there's insufficient liquidity, because they're going to move a huge number of shares of stock or a huge number of contracts on the futures markets. They're going to wait to take over as soon as the market opens. So a gap is created by the small commercial trader like you or I, trading 100 shares, 200 shares, maybe even 500 shares. They're going to run in, they're going to take the trade based on some bad news or whatever they perceive. They're going to push Facebook down, and then the professionals are going to come in, and they're going to decide the ultimate direction of Facebook. If they decide that this gap down based on the amateur move is unwarranted, they're going to fill the gap and take Facebook right back up. If they believe that this is an appropriate move, they're going to push it down. Now, in this particular case on the move down, you only had the fast cash line first. The slower line came in a little bit later. This is all the tick data. This is all the volume data. But it gave you a definite direction to trade. Now, look at the following day on Facebook. On the hourly, you get a gap up. And it rolls sideways for a small period of time, the fast cash line, which is what I call it, I don't call it the tick data, the fast cash line turns green, and you can get in right at the start of the 60-minute candle to the top, and there's an enormous amount of profit here to trade Facebook long. Now you're trading in both cases in the direction of the gap. Now most of the time you're going to find that to be the case. Sometimes I'm going to show you some counter trend trades against the direction of the gap, but the amateurs pushed it up and the professionals came in and said, you guys are right, and we're going to really rocket this stock up once we move in. Same thing here. The amateurs came in, gapped it down, and then the professionals came in, confirmed it on the metrics indicator, and down it went. Now this is just a regular trend trade on, this is the NQ. And here we're looking at the NQ cash markets. And the NQ cash is strong to the downside. So we're going to take the NQ market, the NQ futures market, to the short side. And this is a 3-minute. A lot of traders like the 3-minute. I like to trade range bars, but I wanted to show that this indicator is independent of time and independent of instrument. It'll trade anything for you. Here's the consolidation entry based, this is a system generated entry, but I don't even want you to worry about that. You can trade this on any type of system. You can use it on the trading system that you have. It gives you a direction, and you can't counter trend trade against this direction. This long candle up here is doomed. And as long as you got dual reds, it's a great candle to fade and take right back to the downside. You've got amateur traders deciding the bottom is here. All the metrics are still telling you the NQ is, the cash NQ is heading down. Once it hits upside resistance, you're going to fade it, and you've got a nice move to the downside. You're never going to go along with these traders. These are the amateurs, and we're going to play professional. That's the way we want to trade. Same thing here. You get an amateur retracement back to resistance. It's not going to be successful. It's going to fail at resistance, and we're going to take the trade short. And here's just this is just a routine E-mini, 9 1/4 points. And this is on 12/17. I'm sorry, this is on 9/11. This is a 5-range chart, 9 1/4 points. Now, you have an entry on our system. This is a consolidation entry, strategy entry, and strategy entry. Both system-generated entries, both on retracements back to support, continuation long. Retracement back to support, always in the direction of the cash metrics, looking at 21 individual parameters on the cash markets. No other indicator has ever looked at the cash indices when you're trading the futures markets. What everyone else is looking at is I saw a webinar a couple days ago, and they were talking about how specific stocks require different kinds of oscillators. Oh, if you're in this stock, you use relative strength. If you're in this stock, use fast stochastic. If you're in this stock, you use slow stochastic. If you're in this stock, you use Williams K. I never heard such a bunch of bull, because they're the same formula, just tweaked. That's all there is. It's the inputs in the back. An oscillator is an oscillator. It's not going to make you any more money depending upon which one you do. What you have to do is determine what's going on in the cash markets to give you a great trade on the futures markets. Now here's another market open trade on the E-mini. Rarely do you get a trade that at the open that you have the dual quants or the dual cash metrics aligned to the upside. And boom, on a 3-minute, you get a huge move, 7 1/4 points. Now remember, trading the open is very dangerous, because there's a market imbalance at the open of the amateur traders who have thrown in contracts pre-market or at the open, and the market kind of shifts around. But this slow cash line is very stable, and when it goes green, it tends to stay green. The upper line comes in fast, but it needs that support. And when you have the dual greens, you can see through the move. It went yellow. But the slower, more stable volume-based metric stayed green throughout the move. Here's Walmart. Now this is a really nice move on Walmart. And here is where you counter trend trade the gap. Here are the amateurs gapping Walmart up. But look at the metrics. Are you going to decide that you're going to take Walmart higher? Well, the answer is no. Now, you could have taken this first move down, but the best thing to do is wait for the first group of amateur traders to move it up and fade it. Now, you could have taken this move all the way down, but what I did was I figured, okay, you're going to take it to support and take it out. You get another group of amateur traders, you take it down to somewhere around support and take it out. Another group counter trend trade it, and down you go. At some point, you can get the trade all the way down here until this fast cash line turns. And here the metrics start to turn. So here's where you know you've hit a bottom. And you let all of these, look at this big counter trend trade move, this counter move up. Now this may take you out of the trade, but all it gives you is another opportunity to get into the trade to the short side. You're never going to trade in this direction, and you're going to look for a roll back to the downside. Here is Lennar. Now people think you can't make a lot of money on non-beta stocks. Like you have to trade Facebook, you have to trade Netflix, you have to trade expensive stocks, or you have to fiddle around with those small biotechs. You have to trade the momentum break. 70% of momentum breakouts fail. There's a huge trading organization that does an amazing amount of advertising, and what they do at the open is they look for a small biotech that's going to break out, and they jump on it, and they try to make all their money in the first 3 minutes. And it's universally unsuccessful. All you do with Lennar, this is really at the close of the session, is you look for an opportunity to go short. Now, counter trend trading is very dangerous, except when both of these cash metric lines rotate. Then all the market internals that are affecting Lennar have reversed. And here's where you get the potential for a counter trend trade. Now, I don't counter trend trade personally, and I don't recommend counter trend trading. But if you want to do it, don't counter trend trade unless both of these cash metric lines roll around and all the market internals that govern the direction of Lennar have rotated for you. There's your potential reversal trade. And here's an enormous trade on a 3-minute Tesla. And you can see the fast cash, yellow, green, red really indicates the termination of the trade. It's over. But this is a huge move. Now, I didn't look and see where the entry is. It's about 365. This is about a $12 move. And this is a very low risk trade, because you're trading in the direction of all the market internals that govern the direction of Tesla. Now here's another market open trade on Tesla. The market opens right here. It's 9:30, and you get two amateur groups of traders just putzing around here. They're not really sure what's going on with Tesla, but they create these 2 3-minute candles. Now, what you're going to find is that sometimes pre-market, the cash metric lines don't operate. And that's because pre-market, there's not enough data that's funneled through Kinetic to give you an accurate line, and when it is not enough data, the lines just are yellow. And that happens a lot pre-market. So you're not going to be able to trade pre-market, and I don't recommend you do it anyway. But you oftentimes will not get the help of these cash metric lines if you try to do it. But if you're trading right off support, and the 50's up, and the 15's up, and both cash lines go green, and they go green the candle before, you get in as quickly as you can, and you've got a gigantic move to the upside on Tesla. And this is a low-risk trade. It's an $8.46 trade. Now, the stock's expensive. Don't get me wrong, but this is operational on a stock that costs any amount of money. Now, I wanted to, to kind of close with just some regular trend trades. Now, this is our whole system, and I don't want you to really look at much else. But here are our cash metric lines on Facebook. Now, this is the entry right here, based on our system. You get 40 cents of profit on 10 cents of risk. That's a 4-to-1 reward, a 4-to-1 reward to risk ratio. You cannot beat that. You trade in the direction of the cash metrics. And you can see that into the trade they went yellow, and this went yellow and then green, but they got you in, and the trade's on the move, and your automatic trade management strategy takes over, and you ride the trade. Here's another one on Perrigo. That's a generic pharmaceutical company. It's right off the value area high on a C candle entry in the direction of both cash quants, both cash metrics, excuse me. And up you go. 75% of profit on 10 cents of risk. And we're not going to talk about absolute amounts of money. If you trade 100 shares, you make $75. If you trade 1,000, you make $750. But the risk to reward ratio here is unbelievably, it's incredible, very, very much in your favor. I mean, you have to get 7 losers on 10 cents of risk to eclipse this one winner. And you're never going to get 7 losers. Here's a short on Tesla, 65 cents on 15 cents of risk. Here's a short on Netflix, right off of the value area low. Here are the metrics, red, and you make 99 cents on 15 cents of risk. And this is not your gimmick stock trading system. This is trading a stock scientifically. So because you have a great idea of the direction, you just find the entry based on the system that you use. Don't counter trend trade these lines. Here's Apple on a 13 range, 78 cents of profit on 15 cents of risk, always in the direction of these metrics. And you see, if you're not in the trade and you get these counter trend traders, you're going to roll this trade to the downside. Here's what you're exploiting. Every amateur move back to resistance against the direction of the trend. Here, up, you've got the slow cash turn first here. It happens sometimes. And then a roll back to the downside. Here's 65 cents on Tesla. That looks like the same trade. I might have duplicated it. I'm sorry. There's the same trade on Facebook. This is a different trade on Akamai. 30 cents of profit on 7 cents of risk. Now I'll take that any day. That's what? That's over a 4-to-1 risk reward to risk on that trade. Both lines red. Oh, here are the cash metrics down here. Red, red. Here's Wynn Resorts. I've traded Wynn a lot. I've used it in my options portfolio a lot. I really like the stock. It's a very, very non-volatile stock. It's a trending stock. It's an expensive stock, but it doesn't have a lot of whipsaw. And when you get a nice trend like you have here out of consolidation, and you've got your cash metrics right here, cash metrics, red, red, you're going to get yourself a nice short move on Wynn. 29 cents on 7 cents of risk. It's imperceptible. I mean, if you have enough money, you could make $290 on a risk of $70. I mean, that's pretty remarkable. Here's, again, another trade of Tesla. This is a new trade. There's your cash metrics, red, red. So you can use it to trade 4 methods. It's going to tell you how to trend trade. Now, obviously, trend trades should really be, your bread and butter trade. But if you want to trade gaps, it's going to show you how to trade them professionally. If a stock gaps up, you're going to look for the gap to continue in the direction of the cash metrics. But you saw one time with Walmart where the amateur gap was overrun immediately and closed by the professionals. If you ran with Walmart to the upside, you would have gotten run over real fast because both cash metric lines went red, red, and Walmart was a stock in which the gap closed as soon as the market opened. You can trade the market open as long as everything settles down. And you know how you know things have settled down? You're not going to get 21 individual indices all in the same direction with 2 green lines or 2 red lines unless the market is in sync. You're not going to get all of the individual indices that demarcate volume and all that demarcate ticks all in alignment unless it settles down. And when the market opens and you get the 2 greens, and a lot of times the market will open and one will be green, one will be red, and they'll be changing color rapidly because there is no sync. And there's no clear-cut market direction. But when it locks, you take the open and you can really make a lot of money. That's how you trade an open professionally. You don't guess. You don't look at what it did yesterday or the day before. You don't look at the Globex high and the Globex low. And you don't look at any gimmick. You want to look at multiple market internals, and they're going to tell you market direction. And then you can potentially trade reversals, but you need both metric lines to turn. Now, I've looked at reversals on one line. A lot of times they work, but sometimes they fail. And when you get a signal that works a lot of times but fails sometimes, it isn't any good. It's got to work 70 to 90% of the time. And on a signal metric color reversal, it just doesn't have the predictive value you need to guarantee that you're going to make money. So the reversals, if you want to take them at all, are going to be taken when both of those lines roll. Now, I just wanted to give you a couple of quick testimonials. Everybody can give fake testimonials, but these are 2 coming right from Top Step Trader. And this is Jersey Tony, and I'm going to make it really short. And these people, Jersey Tony has a publishable track record because he's with Top Step. And he says, Right Line and Top Step has helped me, and I'm confident that it will also help other traders who aspire to become consistently profitable traders. And this is D. Moore, and I'm just going to, D. Moore won the $50,000 combine in 2016 for Top Step. He made more money than anybody else trading this $50,000 bracket using our system. And he goes, when I got funded, I got 21 straight days without a loss. And basically, he just talks about how good our system is. And, you know, and in particular, some of our entries. And he talks about order flow and, you know, some of our other indicators. But he relies heavily on the cash metrics, just like all of our traders do, and like I do. So our goal is really to combine a lot of independent variables into a simple trading platform or a simple trading indicator that's, I always leave out the T in that optimized, to provide you with remarkably accurate entries and or direction. And let me tell you, direction I think is 70% of it. If you got a direction, you can get a retracement. Now I saw a webinar that only had to do with whether or not a retracement is the beginning of a reversal or the continuation of a trade back into the trend. These dual cash metrics are going to give you that answer. If you get a pullback to support and both cash metrics are green or blue, they're green, you're going to get a continuation. If you get a pull up to resistance and both cash metrics are red, you're going to take the trade short. All you're going to do is exploit those counter trend traders and trade in right back into the trend in the direction of the dual cash lines. You'll get yourself some very nice trades. And here's the key. They're low risk trades when you enter, and they potentially have high reward. That's the kind of trade you want. You want a trade that has a low risk and a high reward. And you saw the stock trades. You're risking 8 cents, 10 cents, or 15 cents to potentially make 5 times to 7 times the amount. So here's the special offer. The indicator is normally $9.97. We're giving it to you for $4.97. And you get 1 month in our live trading room. Now, we don't trade stocks in the live trading room. We just trade futures. But we rely heavily on those cash metric lines to trade them. If I trade a lot on the NQ, I want to know what's going on the cash NQ, and I want to trade in the same direction. Now we have a lot of people in the room. So for the first 10 orders, we're going to give the indicator plus 3 months in the room, plus access to our video tutorial library, plus a second license. So if you want to trade it on somebody else, on another computer or on a laptop, we'll give you the second license for nothing. So let me see if there are any questions. Hang on one sec. All right, hold on, because I know there were probably some for Lee, and I just want to go past him. Okay, all right, Jim. Well, listen, Jim said, I like trading gaps. Well, Jim, if you trade them, I'm telling you this is going to help you out. Listen, if you want to fade the initial move, Jim, you don't want to trade against the direction of these cash metrics. If you do, they're likely going to roll you over. You got to trade in their direction. Thank you. Okay. What about the, listen, I haven't looked at trading new, okay, I think these are questions for Lee, because this is non-farm payroll, and I think this is at 133, and I can't remember when I started. Okay, these are not for me here. Okay, I still think this is Lee. Very funny. Nice. Lee's got some nice questions here. Yes, we have, Rob, and you're going to get them early next week. They are done. They are completely done, Bob. I promise you. Jim, the continuum data feed is not going to work because the continuum data feed, I believe, is a futures data feed. What you need to do is you need to augment your trader with a stock data feed. Remember, these run off of stock metrics, not off of futures metrics. If you trade stocks, they're coming off a stock data feed. Even if you're trading the futures markets, they're coming off of a stock data feed. So what you have to do is you have to use Kinetic. So it's going to cost you $55 a month, which I promise you you're going to make back easily. And you're going to have to run both data feeds at the same time if you trade futures, and Kinetic will also get you hundreds of stocks. So it may be the only data feed that you need if you trade stocks, but if you trade futures, you may be able to, listen, you may be able to get it from your broker. I don't know. But I pay $55 a month for the Kinetic data feed. Thank you, Ranjit. He said Akamai is about $47.06. Hey London. Hey Raj. Oh my God, another terror attack in London. Yeah, we're selling them as standalones, John. That's exactly what we're doing. Now, if you buy them, you get them for the futures markets and for the stock. So they're really 8 sets. You get a NASDAQ, Dow, Russell, and E-mini for stocks, and you get one for the futures. And they're different. But you get all of them. Bob, I know you're beating me up here. Listen, we just wanted to get them perfect before we sent them out. And we have, and I promise you, you're going to get them, Bob. Listen, Raj, it depends on what you're trading. If you're trading a 5 range, you're going to take your stop is going to be 1 tick below the entry candle. Yeah, and your targets depend on the average true range of your instrument. I mean, I can give you an example. When we trade a 13 range NASDAQ, it's a 15 tick stop, and our first target's 10, our second target's 20, and our third target is 30 ticks. So it's really, it is really instrument dependent, and it's based on the average true range of your instrument. So I can't give you a blanket answer. Like our E-mini is first target 7 ticks, second target, first target 4 ticks, second target 7 ticks, third target 11 ticks. So they're all different. But we have them posted on our website for futures, but I can show you how to calculate them for stocks based on the average true range of the instrument and their volatility. Larry, we have not offered them before. We just perfected them in the last 2 weeks. We've been working on them for months, as Bob, who's a member of our room, is giving me lots of hematomas, but because he's right. I mean, we held up on releasing them until we got them perfect. And the hurricane, we're in South Florida, held us up a week. Now they are perfect and they are integrated into our system. And today we're selling them as a break-off and a standalone system, as a standalone indicator. Jim, it'll work with a continuum data feed again, but you need that separate stock data feed. Now, oftentimes your broker will provide it, but if your broker doesn't, then you need to get a Kinetic data feed. And I'll show it to you really quickly. I just want to show you, I just want to just give you this real quick. Here, we're at rightlinetrading.com, info@rightlinetrading.com, and we're at 855-765-6681, and I'll go to that, but I'm going to show you real quick. I'll save you some time. If you hang on 1 second, I'm just going to bring this up, and I'm going to show you on Google. Hopefully you can still see. Here's the Kinetic data feed. And it's right here. Now, this is what we use. I'm not saying this is what you have to use, but all you need to do is go down here. It's $55 per month, and here are the market metrics. And these are where we pull those 21 individual ticker symbols that we use to create the cash metrics. All off of here. There are a couple of hundred. I think there are 500 here, but we use 21 of them. And it was hard to find out which the best 21 were. And the data feed is $55 per month. So let me just take that out. Now, like I said, again, you may be able to get that for free. I don't know. I don't get it for free. I have to pay for it. Yeah, it works in NinjaTrader 7. Okay, hang on a second here. I'm going to go to the bottom. Okay, but I swear, Jim, hold me to that promise. If I don't, you can come down to Florida and you can get me. But I'm telling you that that's it. If Ninja's your broker, hold on 1 second here. Let me just go back here. Okay, thank you. No, you know, I don't know, Kurt. Kurt said we'll work with any stock data feed. The stock data feed has to break it down into all those individual symbols. So I can't give you a blanket yes or a blanket no. Now, according to Sergio, it will work with almost any stock data feed. But I don't want to give you a blanket yes, because it has to have all those individual symbols which you can plug into the indicator to make it run. So I can't give you an absolute yes or no. But let me tell you, for $55 a month, the Kinetic data feed is really cheap. And all you need to do is get one successful trade to pay for it 3 times over. I haven't done that yet, Bob, but we will do. I'm going to do that. No, you do not need a multi-broker to run these two. A standard data feed, Joe, the Ninja platform allows you to run 2 data feeds at the same time. We'll configure them for you. Whatever your broker is now, whether it's CQG, Continuum, we can add the Kinetic data feed. It's very, very easy for us to do, and we'll do the whole configuration. Sergio will put the 21 symbols into your back end and configure all the quants for you, of all the metrics. It's not easy for you to do, and it'll take him 20 minutes. Okay, Ranjit has to eat. No, we're doing it, Bob. I'm telling you. You got it. Okay, James, that's our entire system. I didn't want to show those. It's offered on Sierra, Larry. It is offered. And those are additional indicators, and I don't want to get into them because then I confuse people, and people think that they're also offered. I mean, this is not our entire system. This is a piece of it that helps you get a direction for an inexpensive price, and I think it's the most powerful single indicator that we have, and one that mandates a market direction. And you know, I mean, I find that the discretionary component of day trading is tough, and that there's some gray zone trades. This will help clarify those gray zones. If you're not sure whether to take a short trade because the market's a little oversold and both cash metrics are red, you can take the short. The market's overbought and they're both green, take the long. Also, sometimes you can take a continuation trade or wait and take it out of consolidation. Here, don't wait for consolidation. Just take the continuation trade. It really does clear up some of the nebulous things that you face as a day trader or swing trader that just come up, that it's impossible to resolve, because they're price action scenarios where what your decision is discretionary and there's no right or no wrong, but this gives you a great indication. The fast cash is going to clear out of your direction quickly, and if it does, then if you're not sure about the trade, then stand aside. So it really is going to help you in all the gray zones. It's going to help you trade the open. And for me, if you want to trade a gap, I think it's the only way to trade a gap. You trade it because the cash metric lines are determined by the professional traders. It takes big money to align 21 volume and 21 tick metrics in the same direction. No amateur trader can do that. So if you want to trade a gap or you want to trade an open, this is what's going to give you that direction of that open. So I think it's going to make day trading or swing trading for you a lot clearer. Also, the longer time zones. And here's the other thing. When you get into a trade, the other question is, should I stay in it or should I close it and bank my profit? If both lines, including the fast line, stay red on a short, don't bail out. If both lines are green and you're on a long trade, don't bail out. Now the trade can still retrace and you can still get back in long. But if you're not sure what to do, you can base it on the fast line, and it will give you a really good way of deciding whether you can try to gamble and get more profit or whether it's time to take your profit and walk. It is offered on Sierra. Yeah, they're all waterproof, Ted. We got pretty waterlogged here. We had no internet, no lights for 4 days. There's a lot of damage around here, but you know, we dug out and we survived. Okay, so that's it. Can it be used? No, it's not too much information, Larry. All the indicators we already have in the system, this is a nice augmenter. It takes a little bit of time. I mean, Larry's I think got the full system. I don't know, but let me tell you, additional information that helps you trade is never wasted. And it takes a little bit of time to understand the visuals, but once you get acquainted with it with a little chart time, it's going to help, definitely help you, because they're each measuring completely different things. Our quants are looking solely at the futures markets. Our cash metrics are looking at the cash markets. So they're completely, they're not only looking at different time frames, they're looking at different markets. So they're very relevant individual indicators, very relevant. So in this particular case, it is not, as they say, TMI, which is too much information. Not if it's non-redundant and non-overlapping. And in no way is that information overlapping or redundant, because it's looking at completely different markets. So that's it. I hope you got some good information about trend trading, gaps, continuation trades, trying to trade reversals. So thank you guys. I really appreciate it. Again, we're at 855-765-6681, and we're at rightlinetrading.com or info@rightlinetrading.com. All of you have a great afternoon and have a really great weekend. Take care. You can call us if you have any questions. So long. Have a great day. Bye-bye.